At some point, usually very quietly, money decides it's had enough. Not people, not voters, not presidents. Money. It doesn't announce its decision. It doesn't hold a press conference. It just stops showing up. And when that happens to a country, everything changes. Right now, we live in a world obsessed with capital, foreign investment, hot money, global flows, trillions of dollars moving across borders at the speed of a click. Governments celebrate it. Markets demand it. News anchors treat it like a scoreboard. But here's the uncomfortable truth most people never hear. Capital is not loyal. Capital is not patient. And capital does not care about national pride. It only cares about trust. And trust, once broken, is brutally expensive to rebuild. To understand why this matters now, we need to rewind a little. For decades, nations learned a simple lesson. If you want growth without pain, borrow it. Sell bonds, open markets, promise stability. Let global investors fund your ambitions today and worry about repayment tomorrow. At first, it works beautifully. Money flows in, currencies strengthen, stock markets rise, politicians take credit. It feels like prosperity. It looks like confidence. But beneath the surface, something more fragile is forming. A relationship built almost entirely on belief. Because when capital enters a country, it's not committing to the nation itself. It's renting the idea that the nation will behave predictably, predictable rules. Predictable debt payments, predictable politics, predictable inflation. That's the deal. And as long as the deal holds, capital stays. So how does this system actually work? Let's say a country needs money. To build roads, to fund welfare, to cover deficits, it issues bonds. Investors buy them. In exchange, the country promises to pay interest and eventually return the principal. Simple enough, but here's the catch. Most of these investors aren't planning to stay until maturity. They plan to sell, quickly, to someone else. For a profit, that means trust isn't anchored to the long-term future. It's anchored to the next quarter, the moment investors suspect higher inflation, political instability, debt stress, or policy surprises. They reassess, not slowly, instantly. They ask one question. Can I get out before everyone else does? And this is where the math turns uncomfortable. If enough investors decide to leave, the currency weakens. Imports become expensive. Inflation rises. Interest rates are hiked to defend the currency. Debt servicing costs explode. Growth slows. The very tools used to attract capital become weapons against the economy. And here's the cruel irony. The country may not have done anything catastrophically wrong. It might have missed a target, delayed a reform, elected the wrong coalition, signaled uncertainty. But capital doesn't wait for clarity. It prices fear. We've seen this movie many times. Mexico in the 1990s, Asia in 1997, Russia in 1998, Greece after 2009, Argentina repeatedly. Each time the story sounds different. Different politics, different excuses, different villains, but the mechanism is always the same. Trust fractures, money leaves, the economy absorbs the shock, and the public narrative never matches the reality. Governments talk about temporary volatility. Markets talk about healthy corrections. Commentators talk about overreactions. Meanwhile, ordinary people experience something much simpler. Their currency buys less. Their savings shrink. Their jobs feel less secure. Capital exits cleanly. Citizens don't. What makes this system especially dangerous today is scale. Global capital flows are larger than ever, faster than ever, more concentrated than ever. A handful of large funds can move billions in hours, and many countries have built entire economic models assuming that money will always come back. Cheap debt, rolling maturities, short-term financing. It works until it doesn't, because trust isn't lost gradually. It snaps, and once snapped, rebuilding it requires exactly the opposite of what politics rewards: higher taxes, lower spending, higher interest rates, years of restraint. Voters are told it's necessary. Markets are told it's reassuring. Neither is truly satisfied, which leads us to the deeper, more uncomfortable question: what happens when capital stops trusting not just one nation, but the system itself? When debts are high everywhere? When politics is unstable everywhere? When inflation surprises are common everywhere? In that world, capital doesn't disappear. It concentrates. It hides. It demands higher returns for higher risk, and countries discover something they were never taught to plan for: that access to money was never guaranteed. It was conditional. The irony is that capital is often described as brave, bold, forward-looking. In reality, it's deeply cautious, almost paranoid. It runs at the first sign of uncertainty, and it always outruns governments. So when you hear leaders promise that markets are confident or that investors are on our side, remember this: confidence is not a friendship, it's a lease agreement, and the moment the terms change, capital doesn't negotiate, it leaves.